Did you know that 67% of Americans are terrified they won't have enough money to retire? That's over 175 million people lying awake at night, wondering if they'll be working until they're 80. But here's what most people miss. It's not how much you earn that matters most. I'm going to show you how even modest savings can grow into substantial wealth through what Einstein called the eighth wonder of the world, and why understanding this one concept could completely transform your financial future. The retirement reality check. Picture this. After decades of setting your alarm clock, battling traffic, and working long hours, you've finally reached retirement age. Your kids are grown, your mortgage is paid off, and you're ready to enjoy those golden years you've been dreaming about. But then reality hits. Your savings won't last even 5 years at your current lifestyle. That dream retirement, it just evaporated. This isn't a hypothetical scenario. It's the harsh reality facing millions of Americans today. Margaret, a 73-year-old former administrative assistant from Ohio, now works part-time at a local grocery store. "I saved what I could," she tells me, her voice tinged with regret. But somehow it wasn't nearly enough. Here's what most people get wrong about retirement planning. We've all heard the standard advice. Save 10 to 15% of your income every month. Financial advisors repeat it. Personal finance books preach it. Your parents probably told you the same thing. But what if I told you the amount you save matters far less than how you save it? Take James and Susan, a couple from Portland who diligently put away $500 every month for 30 years. They followed all the traditional retirement advice, saved consistently, didn't touch the money. Yet at 67, they realized their $180,000 in contributions had only grown to about $320,000. Not nearly enough to support their lifestyle for 20-plus years of retirement. The numbers paint a troubling picture across America. According to recent surveys, 67% of Americans fear they won't have enough money for retirement. And this isn't just a problem for lower-income households. Even among those earning six figures, nearly half express serious concerns about their retirement security. The retirement crisis crosses all income levels. A factory worker in Michigan, a teacher in Texas, and a marketing executive in New York might have vastly different salaries, but they share the same underlying worry. Will my money last long enough? Why does traditional advice fail so many people? Because just save more doesn't address the fundamental problem. It's like telling someone who wants to lose weight to just eat less without explaining nutrition, metabolism, or effective exercise. The emotional toll of this uncertainty is devastating. Retirement anxiety manifests in countless ways. Sleepless nights worrying about healthcare costs, strained relationships as couples argue about finances, and canceled plans to help grandchildren with college or take that dream vacation. Many Americans report postponing retirement entirely, watching their health decline while they continue working simply because they can't afford to stop. Linda, a 69-year-old nurse, describes it plainly. "I lie awake at night wondering if I'll become a burden to my children. That's not the legacy I wanted to leave them." What's most frustrating is that many of these hardworking Americans did everything they thought was right. They weren't frivolous spenders. They didn't make obviously poor financial choices. They simply followed an incomplete strategy, one that missed a crucial mathematical principle that separates those who struggle in retirement from those who thrive. Think about compound interest for a moment. Most people have heard the term, but few truly understand its power or how to harness it effectively. When properly employed, this principle doesn't just improve your retirement outlook, it transforms it completely. The difference between someone who uses this principle and someone who doesn't isn't just a few extra dollars each month. It's often hundreds of thousands of dollars over a lifetime. The silent wealth destroyer. While compound interest works tirelessly to grow your wealth, there's another financial force operating in the opposite direction. That $50,000 emergency fund you've worked so hard to build? In 20 years, it might only buy what $25,000 does today, even though the number in your account hasn't changed. Let's talk about something that's happening to your money right now, whether you realize it or not. While many of us focus on increasing our income or cutting back on spending, there's an invisible thief that's quietly stealing your purchasing power day after day. This silent wealth destroyer has a name: inflation. Simply put, inflation is the steady increase in prices for goods and services over time. It's why a gallon of milk costs more today than it did 5 years ago. It's why your parents or grandparents might talk about buying movie tickets for just $1 or $2. Think about your weekly grocery trip. Have you noticed how the same cart of essentials seems to cost more every year? That's not just your imagination. A loaf of bread that cost around 50 cents in the 1980s will run you over $2.50 today. And this pattern plays out across everything you buy. Here's what makes inflation so dangerous. It's persistent and often invisible in the short term. Recent data shows inflation running at about 3% to 4% annually. That might not sound like much, but let's see what it means for your savings over time. Let's say you've managed to save $100,000, a significant achievement that took years of discipline. If inflation averages just 3% annually, which is actually conservative by historical standards, in 30 years, that $100,000 will only have the purchasing power of about $40,000 in today's dollars. Your money will have lost 60% of its value while sitting safely in your account. But wait, you might say, my money is earning interest in my savings account. Unfortunately, that's where the math gets even more depressing. The average savings account today pays between 0.05% and 0.1% interest. At that rate, your $100,000 would grow to about $100,300 after 30 years. Meanwhile, inflation would have reduced its purchasing power to $40,000. This is why financial experts often describe inflation as a silent wealth destroyer. It erodes your savings without any visible change to the numbers in your account. The dollars are still there. They just buy less and less as time passes. What makes this situation particularly troubling is that many Americans consider themselves financially responsible by keeping their money in safe places like savings accounts or certificates of deposit. But when these vehicles are paying interest rates well below the inflation rate, you're actually losing money in real terms every single year. Think about that for a moment. The financially responsible move you're making, saving diligently in a bank account, is actually guaranteeing that you'll have less purchasing power in the future. It's like running on a treadmill that's gradually speeding up. Despite all your effort, you're falling behind. This reality creates a terrible dilemma for retirees. Many people spend decades saving for retirement, only to find that their carefully accumulated nest egg doesn't stretch nearly as far as they expected. What seemed like a comfortable amount when they retired quickly becomes insufficient as inflation continues its relentless march. For someone living on a fixed income, like many retirees, inflation doesn't just mean minor inconveniences. It can mean having to make painful choices between necessities like medication, heating, or food. The safe approach to saving can ultimately lead to significant financial strain in retirement. The purchasing power problem. Those financial milestones we celebrate often hide a troubling truth. Think about this. Reaching $100,000 in savings feels like crossing a significant threshold, something worthy of celebration. You've been disciplined, made sacrifices, and finally hit six figures. But that celebration might be premature when you consider what that money will actually buy you in the future. The financial security you think you're building might be an illusion. What $100,000 purchased in 1993 would cost you around $200,000 today. That's not just a small adjustment. It's a complete transformation of your purchasing power. And this erosion happens silently, without any visible change to the number in your account. Let's look at some real-world examples that make this crystal clear. Back in 1993, you could buy a perfectly nice home for about $113,000 in many parts of the country. Today, that same level of housing would set you back around $400,000. The home ownership dream hasn't just gotten a little more expensive. It's become dramatically less accessible despite your diligent saving. The story repeats itself across major life purchases. Remember that brand new car your parents might have bought for $15,000 in 1993? The average new vehicle today costs approximately $48,000. That's more than 3 times the price for essentially the same transportation function. Education costs paint an even more alarming picture. A year of college that cost about $10,000 in 1993 now demands over $25,000 annually at public institutions. If you're saving for your child's education, the goalposts aren't just moving, they're racing away from you. Here's where it gets personal. Imagine you're 40 years old and proud of having saved $100,000. That feels substantial today. But fast forward 25 years to your retirement at 65, and that same $100,000, if left in a traditional savings account or even investments that barely keep pace with inflation, might only buy what $50,000 does today. Half your purchasing power gone. The math works against static savings in a way most people don't. Consider, let's say inflation continues at its historical average of about 3% annually. Every year, your money loses 3% of its buying power. That doesn't sound catastrophic in any single year, but over 25 years? Compound that negative growth, and you've lost nearly half your money's value without spending a dime. This problem becomes painfully real in retirement. Many people discover too late that their carefully accumulated nest egg doesn't stretch nearly as far as they expected. What seemed like adequate planning turns into difficult choices. This explains why so many retirees find themselves downsizing their homes not as a lifestyle choice, but as a financial necessity. Others cut back on travel plans they've dreamed about for decades or reduce their standard of living in unexpected ways. The disconnect happens because most people plan in today's dollars without fully accounting for tomorrow's costs. It's like aiming at a target that keeps moving farther away while you're shooting. Your $100,000 target today might need to be $200,000 or more just to stay in the same place relative to your purchasing power. What makes this situation particularly challenging is that we naturally think in terms of today's prices. When you imagine your retirement lifestyle, you're probably thinking about what things cost now, not what they'll cost then. This mental blind spot leads even careful planners astray. Einstein's eighth wonder of the world. That mental blind spot preventing us from seeing future costs also blinds us to the most powerful wealth-building tool in history. What if I told you the mathematical principle that can transform $200 monthly investments into millions doesn't require special connections, insider knowledge, or even much risk? The answer lies in what Einstein allegedly called the eighth wonder of the world. Compound interest might sound like just another boring financial term, but it's actually the closest thing to financial magic that exists in the real world. Einstein reportedly said, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." Whether he actually said this is debated, but the wisdom behind it is undeniable. Most of us think about interest as just a small percentage we earn on our savings, that little 0.1% your bank proudly advertises. But compound interest operates on an entirely different level, and understanding the difference between simple and compound interest is crucial. Let me break it down. With simple interest, you only earn interest on your original investment, your principal. If you put $1,000 in an account with 5% simple interest, you'll earn exactly $50 every year forever. But with compound interest, you earn interest on your interest too. So in year 1, you earn $50 on your $1,000. But in year 2, you earn 5% on $1,050, which is $52.50. In year 3, you earn interest on $1,102.50, and on it goes, creating an exponential growth pattern. This might not sound impressive with small numbers, but let's look at the classic penny doubling example. Imagine starting with just 1 penny that doubles every day for a month. By day 30, you'd have over $10 million. That's not a typo. 1 penny, doubled daily for a month, creates an 8-figure sum. While this specific scenario isn't realistic in the investment world, it perfectly illustrates the explosive power of exponential growth. Now let's look at something more practical. The stock market has historically returned around 7 to 10% annually on average. The S&P 500, which tracks 500 large American companies, has averaged roughly 10% returns per year over the long term. At these rates, money doesn't just grow, it multiplies. Here's what this looks like in real life. Someone who invests $200 monthly from age 25 to 35, just 10 years of investing, and then never adds another penny can potentially end up with more money at retirement than someone who starts investing $500 monthly at age 35 and continues until retirement. The early investor puts in far less money, but ends up with more. That's the power of time combined with compound interest. Consider the coffee savings plan that financial advisors often mention. Someone who skips a daily $5 coffee and invests that money instead could accumulate over $300,000 after 30 years, assuming a 7% annual return. That morning coffee might taste good, But does it taste $300,000 good? The process works like a snowball rolling downhill. At first, the growth seems painfully slow, almost unnoticeable. But as your investment grows, the snowball gets bigger, picks up speed, and eventually creates an avalanche of returns. The early stages require patience, but the later stages can be truly life-changing. What makes compound interest particularly powerful is its accessibility. Unlike other wealth-building methods that might require special connections, insider knowledge, or significant risk, compound interest is available to anyone who understands and applies it consistently. It doesn't care about your background, education, or social connections. It responds to time and consistency. The growth misconception. While compound interest works reliably for anyone with patience, our brains play a frustrating trick on us when visualizing how money actually grows. Think about it. If I handed you a piece of paper right now and asked you to draw how $10,000 grows over 40 years with compound interest, what would your sketch look like? Almost everyone draws the same thing, a nice, neat diagonal line moving steadily upward from left to right. It's intuitive, right? We put money in, it grows a little each year, and we end up with a smooth, predictable climb toward our financial goals. But here's where things get interesting. That mental image is completely wrong. The actual growth pattern of compound interest looks nothing like a straight line. In reality, wealth growth through compounding follows a curve that starts almost frustratingly flat, then gradually steepens, and finally shoots dramatically upward in later years. This nonlinear growth pattern challenges our natural expectations, which is why so many people misunderstand how their investments will actually perform over time. This misconception isn't just an interesting mathematical quirk. It has serious consequences for your financial future. When new investors don't see the immediate growth they expect, they often become discouraged. They might think, this isn't working fast enough, or I'm barely making any progress, and end up abandoning their investment strategy right before the real magic starts to happen. Let me explain what actually happens when you invest. During those first several years, your progress will feel painfully slow. If you're putting $200 a month into investments, after a year or two, you might only have a few $100s in returns to show for it. This initial phase feels underwhelming precisely because the base amount you're earning interest on is still relatively small. The snowball analogy works perfectly here. Think about rolling a snowball down a hill. When you first start, the snowball is tiny and picks up just a small amount of additional snow with each rotation. At this stage, the growth seems minimal. But as the snowball gets bigger, each rotation picks up more and more snow. Eventually, what started as a small handful becomes massive, gathering snow at an accelerating rate as it rolls. Your investments work the same way. In the beginning, you're earning returns on just your initial contributions. But over time, you start earning returns on your returns, and then returns on the returns on your returns. This compounding effect creates an exponential growth curve that's relatively flat at the beginning, but explodes upward in the later years. Let's look at what this means in practice. If you invest $1,000 at a 7% annual return, by the end of the first year, you've earned just $70. Not very exciting. After 10 years, that same $1,000 has grown to about $2,000, which means it took a full decade just to double your money. But keep that investment going for another 20 years, and that original $1,000 grows to over $14,000. The further you go, the more dramatic the growth becomes. This is precisely why patience is the secret ingredient in successful investing. The most significant growth happens in the later years of your investment timeline, not the beginning or even the middle. The rule of 72, your doubling calculator. While watching your investments grow slowly at first requires patience, wouldn't it be helpful to know exactly when your money will double? Most people think predicting investment growth requires complex calculations, but there's actually a remarkably simple rule that can transform how you see your financial future with just basic division. Let me introduce you to the rule of 72. It's a powerful mental math shortcut that financial professionals use all the time, yet most everyday investors have never heard of it. The concept is beautifully simple. To figure out how many years it will take for your investment to double, you just divide the number 72 by your annual interest rate. Let's say you have money in an investment earning 7% per year. Using the rule of 72, you would calculate 72 divided by 7 is equal to 10.3. This means your money will double in about 10.3 years. No spreadsheets, no financial advisors, no complicated formulas needed. Just a simple division problem you can do in your head or with a basic calculator. What makes this rule so valuable is how quickly it helps you compare different investment options. Think about a typical savings account offering 2% interest. Using our rule, 72 divided by 2 is equal to 36 years to double your money. 36 years. Compare that to investing in the stock market with its historical average returns around 8%, and suddenly your doubling time drops dramatically. 72 divided by 8 is equal to 9 years. That's a massive difference in how quickly your wealth can grow. The rule of 72 works for virtually any investment vehicle. For bonds typically earning around 4 to 5%, your money might double every 14 to 18 years. For real estate in growing markets that might appreciate at 6% annually, you're looking at a doubling time of 12 years. Each percentage point makes a significant difference in your wealth-building timeline. Now, I should mention that the rule of 72 works best for interest rates between 6% and 10%. Outside that range, the estimates become less precise, especially with very low or very high returns. But for most common investment scenarios, it's remarkably accurate and certainly good enough for quick mental calculations. What I love about this rule is how it instantly clarifies the relationship between interest rates and time. It makes abstract numbers feel concrete and meaningful. Instead of just thinking, this investment earns 7% per year, you can think, this investment doubles my money every decade. That's a powerful mental shift that helps you visualize your financial journey. Let me show you how this might work in real life. Imagine you've managed to save $10,000. If you invest that money in an account earning 9%, the rule of 72 tells you it will take about 8 years to become $20,000. In another 8 years, that $20,000 becomes $40,000. 8 more years, and you're at $80,000. And this is without adding a single additional dollar to your original investment. This mental shortcut also helps you set realistic financial goals. Want to have $500,000 for retirement? If you currently have $125,000 invested earning 8%, you know you'll need 2 doubling periods, about 18 years, to reach your goal. This kind of clarity helps you determine whether your current strategy will get you where you want to go in the time frame you're planning. The rule of 72 reveals something else that's incredibly important: the enormous advantage of even slightly higher returns. Compare a 6% return, doubling every 12 years, with an 8% return, doubling every 9 years. That seemingly small 2% difference means your money doubles the 5-year fortune difference. If a 2% difference in returns creates such dramatic results over time, imagine what happens when you shift another seemingly small variable, your starting date. Most people assume delaying retirement investing by just 5 years means they'll have slightly less money, but the mathematics of compound interest tell a completely different story, one that might fundamentally change how you think about starting soon. Let's look at 2 friends, Emma and Jessica. Both earn similar salaries, and both invest identical amounts each month at the same 7% average return. The only difference: Emma starts at age 25, while Jessica waits until she's 30. By retirement at 65, Emma has about $1.2 million. Jessica, only about $850,000. That 5-year head start gave Emma approximately 40% more money despite contributing only about 12% more in actual dollars. The math seems almost unfair, doesn't it? This dramatic difference occurs because those early contributions have more time to compound. Money invested at 25 has an extra 5 years to double, then double again and again. Each passing decade amplifies the impact of those early dollars beyond what most people intuitively understand. What's even more surprising is what happens when someone invests for just a short period early on versus someone who invests consistently for decades but starts later. This is perfectly illustrated by the classic example that financial expert Dave Ramsey often shares about Ben and Arthur. Ben invests $2,000 a year from age 19 to 26, for a total of just $16,000. Then he stops completely, never adding another penny. Arthur, meanwhile, waits until age 27 to start investing. He puts in the same $2,000 annually, but continues faithfully until age 65. contributing a total of $78,000. Logic might suggest Arthur ends up with substantially more money since he invested nearly 5 times as much. But the reality? By age 65, Ben has approximately $2.2 million, while Arthur has around $1.5 million. Ben's early 8 years of investing outperformed Arthur's 38 years, even though Arthur contributed far more actual dollars. This isn't some mathematical trick. It's the fundamental nature of compound growth. Those early years create the foundation that all future growth builds upon. It's like planting a tree. The sooner you plant it, the more time it has to grow tall and strong. If you're thinking, but I didn't start at 25, don't panic. The second best time to start investing is today. Even if you're 40 or 50, starting now will always beat waiting another 5 years. The psychological barriers that prevent people from starting, fear of market volatility, feeling they need more financial knowledge, or believing they need a large sum to begin, end up costing them tremendously in lost growth potential. Consider this perspective. If you're 40 and hesitating about starting because you feel behind, imagine yourself at 65 looking back. Would you rather have 25 years of growth or 20? The difference could easily be hundreds of thousands of dollars. This is why financial educators are so passionate about encouraging young people to start investing early, even small amounts. A 22-year-old investing just $100 monthly will likely outperform someone starting at 35 investing $500 monthly. The younger investor's advantage isn't intelligence, luck, or even discipline. It's simply time in the market. It's worth noting that for many people, their 20s are when they're dealing with student loans, lower starting salaries, and other financial challenges. But finding even a small amount to invest during these years can have an outsized impact on their financial future decades later. The final years phenomenon. While focusing on early investing is crucial, there's something about compound interest that most financial experts don't emphasize enough. Those final years before retirement, that's when the real magic happens. Think about this. In a typical 40-year investment journey, you'll actually earn more money in the final decade than in the previous 3 decades combined. It's a phenomenon that completely transforms how we should approach retirement planning. Let's break this down with some numbers. When you look at a 40-year investment timeline, approximately 70% of your total wealth accumulation happens in just the final 10 years. Even more striking, about 50 to 70% of your total growth can occur in the last 5 years alone. This means that if your investment grows to $1 million over 40 years, more than half of that amount materializes in just the final few years before retirement. Why does this happen? It's not because you're suddenly getting better returns, or because the market is performing differently. It's simply because you're finally earning substantial returns on an already large principal amount. This creates what financial experts call a snowball effect, where the growth accelerates dramatically in the later stages. Let me give you a concrete example. If you invest $10,000 and maintain a consistent growth rate over 40 years, that investment could grow to over $250,000. But here's the surprising part. While the first 30 years might build your nest egg to around $75,000 to $100,000, the final 10 years could add another $150,000 or more. The growth isn't evenly distributed throughout the timeline. The math shows that roughly 50% of total growth occurs in the last 5 years, 70% in the last 10 years, and up to 90% in the final 15 years of a 40-year investment timeline. This is why financial experts emphasize that your strategy during these critical final years can make or break your retirement. This final years phenomenon has huge implications for retirement planning. Many investors make the mistake of becoming more conservative too early, or worse, they panic during market downturns and withdraw their money just before this explosive growth phase. Staying invested during these final years is absolutely critical because that's when the compound interest machine really kicks into high gear. Think of it like this. During the early years, you're building the foundation and structure of your wealth. But during those final years, you're actually seeing the completion of the entire building, with all the finishing touches that make it truly valuable. For many people, this concept is counterintuitive. We're naturally wired to think about growth in linear terms, a little bit each year adding up over time. But compound interest doesn't work that way. The growth isn't steady or predictable. It's exponential, which means it accelerates dramatically as time goes on. Understanding this phenomenon changes how you should approach retirement planning. If you know that the majority of your wealth will be created in the final years, you'll be less likely to make emotional decisions during market volatility. You'll understand that staying the course, especially in those last 5 to 10 years, is essential for maximizing your returns. It also means that protecting your investments as you approach retirement requires a careful balance. While you want to reduce risk, moving everything to ultra-conservative investments too early could mean missing out on the most powerful wealth-building years of your investment journey. The 843 rule, understanding growth phases. Finding that perfect balance between risk and growth is challenging, especially when most people don't recognize the pattern their investments follow. What if I told you that nearly every successful investment journey follows a predictable 3-phase pattern, and knowing this pattern could prevent you from making the biggest mistake most investors make? Let me introduce you to something called the 843 rule. It's a fascinating concept that breaks down the typical wealth-building journey into 3 distinct phases: 8 years of foundation building, 4 years of accelerated growth, and a final 3 years of explosive expansion. Understanding this pattern completely changes how you think about your investment timeline. During those first 8 years, your investments grow at a steady but seemingly slow pace. This is the foundation phase where patience is truly tested. Let's look at what happens with a $10,000 investment earning around 8% annually. After those initial 8 years, your investment might grow to about $17,799. Not bad, but hardly life-changing, right? This is precisely when many investors feel discouraged and question whether their money could be better used elsewhere. Think about it. You've been diligently setting aside money for nearly a decade, and the results might feel underwhelming. Your friends who spent that money on vacations or home renovations have tangible memories and improvements to show for their money, while you're looking at account statements with what seems like modest growth. This psychological challenge during the initial phase is exactly why many people abandon their investment strategy too early. But if you stick with it, something interesting happens in the next 4 years. This is when your investment begins to gain real momentum. That same $10,000 initial investment could grow from $17,799 to around $27,271 during this phase. The growth is becoming more noticeable now. Your money is working harder because the base amount earning interest has increased substantially. You're starting to see the power of compound interest in action as your investment accumulates value more quickly. Here's where things get really exciting. Those final 3 years represent the explosion phase of the 843 rule. During this short period, your investment could jump from $27,271 to approximately $32,888. This means your money grows more in these 3 years than it did in those challenging first 8 years, despite the time frame being less than half as long. This is the phase where wealth creation truly accelerates. The 843 rule isn't just a theoretical concept. It's a practical roadmap for financial planning that works across various investment types. Whether you're investing in stocks, bonds, or real estate, this pattern tends to hold true, though specific growth rates will vary depending on market conditions and the particular assets you choose. What makes this rule so powerful is that it helps you understand why staying the course is so critical. If you can visualize these 3 distinct phases before you start investing, you'll be mentally prepared for that initial slow growth period. You'll recognize it as a normal part of the process rather than a sign that your investment strategy isn't working. This knowledge is particularly valuable when you're halfway through that 8-year foundation phase and starting to question your choices. Instead of getting discouraged, you can remind yourself that you're building the necessary foundation for the accelerated growth that will come in phases 2 and 3. The early bird advantage. Time is more valuable than money when it comes to building wealth. This might sound counterintuitive, but let me introduce you to 2 people whose stories perfectly illustrate this principle. Meet Sarah and Michael. Their investment journeys couldn't be more different, but the outcome might completely change how you think about saving for retirement. Sarah starts investing early. At age 25, she begins putting away $200 every month. She maintains this habit for just 10 years and then stops completely at age 35. In total, Sarah invests $24,000 of her own money, $200 times 12 months times 10 years. After stopping her contributions, she simply lets her money sit and grow for the next 30 years until she reaches age 65. Michael takes a different approach. He waits until age 35 to start investing, the exact age when Sarah stopped. But Michael invests more aggressively at $500 per month and continues faithfully contributing this amount until retirement at age 65. Over those 30 years, Michael invests a total of $180,000 of his own money, $500 times 12 months times 30 years. Let's think about this for a second. Michael invested $180,000 while Sarah invested only $24,000. That's 7.5 times more money contributed. Based on contribution amount alone, you'd naturally expect Michael to end up with significantly more money, right? But that's not what happens. If we assume both investments grow at an average annual return of 7%, by retirement at age 65, Sarah ends up with approximately $1 million, while Michael has around $800,000. Wait, how is this possible? Sarah contributed less than 1/7 of what Michael did, yet she ends up with more money? This is the power of an early start. Sarah's money had an additional 10 years to grow compared to Michael's. Those extra years allowed her investment to compound for longer, creating a snowball effect that Michael simply couldn't catch up to despite investing significantly more money. Think of it this way. Sarah's money had 40 years to grow, from age 25 to 65, while Michael's only had 30 years, from age 35 to 65. Those extra 10 years made all the difference. The numbers reveal something profound. When it comes to investing, when you start matters more than how much you invest. Time is truly your greatest advantage. Many people fall into Michael's pattern, waiting until they're older and have more disposable income to start investing seriously. They think, I'll catch up later by investing more. But as we've seen, that approach often falls short because you simply can't make up for lost time. This principle doesn't just apply to retirement savings. It works for any long-term financial goal. Whether you're saving for a child's education, purchasing a home, or building wealth. Starting even a small investment early will usually outperform larger investments started later. The psychological barrier that stops many people from investing early is the misconception that small contributions aren't worth the effort. Young adults often think, what's the point of investing $100 or $200 a month? That won't get me anywhere. But as Sarah's example shows, those small early contributions can be worth far more than larger contributions made later. Think about what this means for different people at various life stages. If you're in your 20s, even a modest monthly investment can grow into substantial wealth by retirement. If you're in your 30s or 40s, you might need to increase your contribution amounts to achieve similar results. And if you're starting even later, you'll likely need to invest significantly more to reach your goals. The key takeaway here isn't to feel discouraged if you're starting later. It's to recognize that beginning now, with whatever amount you can, is essential. The early bird advantage is real, but the second best time to start investing is always today. The retirement planning mistake. You know what's fascinating? When it comes to retirement, we spend so much time focusing on getting started and contributing consistently. But there's a hidden decision point. That's silently determining whether you'll have a comfortable retirement or find yourself working well into your golden years. The difference between withdrawing your investment returns and reinvesting them isn't just a small tweak to your strategy. It could literally double your retirement savings. This is the financial blind spot that most Americans don't even realize they have. Let me paint a clear picture of what's happening here. When you invest $500 monthly and earn dividends or interest, you face a critical choice each time that money hits your account. You can either spend those returns or reinvest them back into your portfolio. This seemingly minor decision compounds dramatically over time. The numbers tell a shocking story. If you invest $500 monthly at a 7% return rate for 30 years, you could accumulate over $800,000 by consistently reinvesting your dividends. But if you withdraw those dividends along the way, your final amount drops to approximately $400,000. That's a staggering difference of $400,000, literally half your potential retirement savings, vanishing because of one small habit. Here's what makes this mistake so common. According to research, about 67% of Americans don't reinvest their dividends. Many people see those quarterly or annual payouts as a bonus to spend rather than fuel for their investment engine. It feels good to see immediate returns, but this short-term thinking comes with an enormous long-term cost. Think about what happens when you reinvest. You're not just earning returns on your original contributions, you're earning returns on your returns, and then returns on those returns. This creates a powerful snowball effect where your money starts working harder for you each year without requiring any additional effort on your part. Financial experts consistently emphasize dividend reinvestment as one of the most powerful wealth-building strategies available. It's like having an automatic system that continuously strengthens your financial position without requiring more money from your pocket. Let's look at how this plays out over different time frames. With consistent dividend reinvestment, your investment growth might look modest in the early years. But as time extends to 20, 30, or 40 years, the gap between reinvesting and withdrawing grows exponentially. Over a 40-year investment timeline, this single decision could mean the difference of up to $1 million in retirement savings. Remember the penny doubling example? That same principle applies here. When you reinvest your returns, you're allowing each penny to continue doubling rather than removing it from the equation. This keeps the exponential growth curve intact rather than flattening it out. The beauty of dividend reinvestment is that it's usually very simple to implement. Most investment platforms offer automatic dividend reinvestment programs that handle the entire process for you. With a few clicks, you can set up your account to automatically plow all returns back into purchasing additional shares, maximizing your compound growth potential. This principle applies across nearly all investment types: stocks, bonds, mutual funds, ETFs, and even some retirement accounts. The mechanism might differ slightly, but the mathematical advantage of reinvestment remains constant. What's particularly interesting is that this mistake affects people across all income levels. Even sophisticated investors with substantial portfolios sometimes fail to recognize how much wealth they're sacrificing by withdrawing their returns rather than reinvesting them. The magic saving number. The magic savings percentage. It sounds like it should be a fixed number, right? Actually, when it comes to retirement saving, that supposedly universal 10 to 15% recommendation we've all heard about hides a crucial truth. While reinvesting dividends creates tremendous wealth growth over time, there's an even more fundamental question we need to address. What percentage of your income should you actually be saving? That standard retirement savings rate you've heard about isn't one size fits all. And getting this wrong could mean the difference between retiring comfortably or working well into your 70s. Here's what financial experts don't emphasize enough. Your ideal savings rate depends dramatically on when you start. If you begin at age 25, saving 10% of your income might be perfectly adequate to reach your retirement goals. But wait until 40, and that number jumps significantly, potentially requiring 25% or more of your income to achieve the same results. This startling difference isn't just about having fewer years to save. It's about losing the most powerful years of compound growth. Think about how time affects your money through the rule of 72. At a 7% interest rate, your investments double approximately every 10 years. This means someone starting at 25 gets 4 potential doubling periods before reaching 65, while someone starting at 40 only gets 2.5. Let me put this in perspective. Each doubling period you miss doesn't just reduce your final amount by a little, it potentially cuts it in half. This is why the recommended savings rate increases so dramatically with age. For someone in their 20s, saving 10 to 12% of income typically puts you on solid footing for retirement. In your 30s, that number rises to about 15 to 20%. But wait until your 40s, and financial advisors often recommend setting aside 25 to 30% of your income. By your 50s, you might need to save 35 to 40% of your income to catch up, a challenging task for most households. What's particularly concerning is that actual savings rates across different age groups in America often fall far short of these percentages. Many individuals save less than the advised minimum, creating a widening gap between what they'll need and what they'll have. The psychological barrier of starting late can make this even more difficult. Many people who begin saving in their 40s or 50s feel it's pointless since they've missed the early compound growth years. But that's exactly the wrong mindset. Even with a late start, consistent contributions can lead to significant growth if invested wisely. Let's look at a practical example. A 25-year-old earning $50,000 who saves 10% $5,000 annually, could accumulate around $1.2 million by age 65, assuming 7% average returns. But a 40-year-old earning $75,000 would need to save about 25%, $18,750 annually, to reach a similar amount by 65. That's a much bigger portion of income, even though the 40-year-old likely has higher expenses like mortgages and children's education costs. This reality creates difficult choices for late starters. Do you drastically increase your savings rate, potentially sacrificing current quality of life? Do you plan to work longer? Or do you adjust your retirement expectations? The answer often involves a combination of approaches. Perhaps you increase your savings to 20% instead of 25%. Plan to work until 70 instead of 65, and adjust your retirement lifestyle expectations slightly. Small changes across multiple factors can make seemingly impossible goals achievable. But here's an important point. These percentages aren't just about retirement. They represent your overall savings rate, which might include emergency funds, home down payments, and other financial goals. The key is ensuring that retirement gets an appropriate portion of your savings, especially as you age. For those feeling overwhelmed by these numbers, remember that starting with something is infinitely better than waiting for the perfect amount. Even if you can only save 5% today, that's a foundation you can build upon. The worst mistake is letting the ideal become the enemy of the good. The investor mindset shift. Beyond all the percentages, calculations, and growth curves we've discussed, there's something even more fundamental to building wealth: your relationship with money itself. The gap between struggling financially and building consistent wealth often has less to do with income and more to do with mindset. And here's the interesting part. Two people with identical financial knowledge can end up with dramatically different results based purely on how they think about money. Most people approach saving and investing with what psychologists call a scarcity mindset. They view money primarily as a limited resource that needs to be carefully protected. This creates a relationship with money that's based on anxiety and fear. Every investment decision becomes stressful because they're focused on what might be lost rather than what could be gained. This mindset creates hesitation, second-guessing, and often complete financial paralysis. Wealthy individuals, on the other hand, don't just see money as something to spend or hoard. They see it as a tool that works for them. This simple perspective shift transforms their entire approach to financial decisions. Instead of asking, "How much could I lose?" they ask, "How can this money work harder for me?" This isn't about being reckless with money. It's about understanding that money in motion creates opportunities for growth that static money never will. Let me give you a practical example. When someone with a scarcity mindset receives a $5,000 bonus, their first thought is usually safety. Put it in a savings account where it won't disappear. A person with a wealth-building mindset might think about which investment vehicle would best put that money to work, understanding that the apparent safety of cash often masks the very real danger of inflation erosion. This mindset difference shows up in daily decisions too. A person with a wealth-building perspective might automatically route a percentage of their paycheck to investments before it ever hits their checking account. They're not making this choice from a place of deprivation, but from understanding the power of consistent investing. They're buying their future freedom first, before spending on present wants. Another key difference is how these two mindsets view financial education. Those with a scarcity mindset often avoid learning more about money because financial topics make them anxious. Wealth builders, in contrast, prioritize financial education and continuous learning. They understand that knowledge reduces uncertainty and improves decision-making, which ultimately leads to better financial outcomes. The great news is that this wealth-building mindset isn't something you're born with. It's something you can develop regardless of your current financial situation. Start by being conscious of your thoughts about money. When you find yourself thinking from a place of scarcity, "I'll never have enough," challenge that thought with evidence that supports abundance. Small, consistent actions compound over time. Practice seeing money as a tool rather than just a resource. When making financial decisions, ask yourself, "How can this money best work for me over the long term?" Rather than just, "What can I buy with this right now?" This simple reframing can dramatically change your decision-making process. Another practical step is to automate your wealth building. Set up automatic transfers to investment accounts so you're building wealth without having to make the decision repeatedly. This removes emotion from the equation and ensures consistency, one of the most important factors in successful investing. Surrounding yourself with people who have healthy money attitudes also helps. Whether in person or through books, podcasts, or online communities, exposing yourself to wealth-building mindsets helps normalize these thought patterns and makes them easier to adopt. Remember that developing this mindset takes time. You might still feel anxiety about money decisions, and that's completely normal. The goal isn't to eliminate the compound growth vehicles. Mindset matters, but so does the vehicle you choose for your financial journey. Think about it this way. Would you rather ride a bicycle or drive a Ferrari on your wealth-building trip? Most people aren't aware that certain investment options are like financial rocket fuel for compound interest, while others barely move the needle on your net worth. Let's get specific about which investments actually make compound interest work hardest for you. The stock market consistently outperforms most other options over time, with historical returns of 7 to 10% annually. Compare that to traditional savings accounts yielding less than 1%, and you'll see why your choice of investment vehicle makes all the difference. That seemingly small percentage gap creates a massive wealth difference over decades. Index funds and ETFs deserve special attention here. They give you broad market exposure without requiring you to pick individual stocks. Think of them as buying a slice of the entire market rather than gambling on individual companies. The beauty is their typically lower fees compared to actively managed funds, which matters tremendously for compound growth. Speaking of fees, they're like a slow leak in your financial tire. A seemingly small 1% fee might not sound like much, but over 30 years, it can reduce your returns by nearly 28%. That's potentially hundreds of thousands of dollars lost. When choosing investment vehicles, always look at the expense ratio. Those tiny percentages make a massive difference in your long-term results. Now, let's talk about supercharging your compound growth with tax advantages. Accounts like 401k, IRAs, and Roth IRAs aren't just savings buckets, they're compound interest accelerators. Here's why. When you invest in a regular taxable account, you pay taxes on your gains each year, which means less money remains invested to continue growing. Tax-advantaged accounts fix this problem. With traditional 401k, and IRAs, your investments grow tax-deferred, meaning all that money that would have gone to taxes stays invested, continuing to compound year after year. With Roth accounts, while you pay taxes up front, all your growth happens completely tax-free. Imagine decades of growth without the government taking a cut along the way. Dividend reinvestment plans, DRIPs, are another powerful tool for automating the compounding process. When companies pay dividends, instead of taking that cash, DRIPs automatically use it to purchase more shares. This creates a beautiful cycle. More shares generate more dividends, which buy more shares, and on it goes. This automation ensures you're always putting compound interest to work without having to think about it. Real estate deserves mention too. While it requires more active management than stocks or funds, property can deliver impressive compound growth. Your investment appreciates in value over time, and if you're collecting rental income, that can be reinvested to purchase additional properties, creating a wealth snowball effect. The combination that financial experts most frequently recommend: tax-advantaged accounts filled with low-fee index funds that automatically reinvest dividends. This trifecta addresses all the key factors: strong returns, minimal fee erosion, tax efficiency, and automated compounding. It's like having 3 accelerators pushing your wealth forward simultaneously. Different life situations call for different approaches, though. If you're young with decades ahead, you might lean heavily towards stock-based investments for maximum growth potential. As you approach retirement, you might shift some money toward more stable options like bonds. The key is understanding which vehicles work best for your specific timeline and goals. One important insight: 2 people with identical saving habits can end up with a 300% difference in final wealth based solely on where they put their money. That's not hyperbole. It's the mathematical reality of compound interest working through different vehicles at different rates. The 3 immediate actions. That 300% wealth difference isn't just for financial experts or the already wealthy. The gap between financial struggle and financial freedom often comes down to just 3 straightforward actions that anyone can take today. What's remarkable is that these steps don't require special knowledge, connections, or even large sums of money to get started. Information overload is one of the biggest barriers to financial success. With countless investment platforms, strategies, and expert opinions, it's easy to feel paralyzed by choices. This analysis paralysis keeps many Americans stuck in planning mode instead of action mode. But wealth building isn't about making perfect decisions. It's about making consistent ones. Let's break down the first action. Start investing something, anything, even if it seems insignificantly small. The good news is that many investment platforms have eliminated the barriers that once made investing feel exclusive. Companies like Robinhood and Webull now allow you to begin with as little as $1. That's right, a single dollar can get you in the game. The amount isn't what matters initially. What matters is establishing the habit and understanding that even modest contributions can grow substantially over time. Here's how to implement this first action. Choose an investment platform that feels comfortable for you. Set a minimum amount that won't strain your budget. Create your account, which typically takes under 10 minutes. Make your initial deposit, and then gradually increase your contributions as your confidence grows. Remember, starting with $25 or $50 monthly is perfectly fine. The key is to begin. The second crucial action is to automate your investments. This simple step removes one of the biggest obstacles to successful investing: human emotion. When investments are automated, you no longer have to wrestle with timing decisions or emotional reactions to market fluctuations. Research consistently shows that automated investing significantly improves outcomes because it enforces disciplined, consistent contributions regardless of market conditions. Setting up automation is surprisingly simple. Log into your investment account, navigate to the Transfer or Contributions section, select the Automatic Transfer option, choose how frequently you want to invest. Weekly, bi-weekly, or monthly works well. And pick a date that aligns with your payday. Once set up, your money goes straight to work before you have a chance to spend it elsewhere. This approach also leverages dollar cost averaging, a strategy that helps smooth out market volatility by purchasing investments at regular intervals, regardless of price. When markets drop, your automatic contribution buys more shares. When markets rise, you purchase fewer shares but benefit from the increasing value of your existing investments. The third action is selecting the right account type for your specific situation. This decision can literally mean hundreds of thousands of dollars difference in your final wealth. For most Americans, this means choosing between an employer-sponsored 401k, a traditional IRA, or a Roth IRA. If your employer offers a 401k with matching contributions, this should typically be your first choice, at least up to the matching amount. It's essentially free money that instantly doubles your investment up to a certain percentage. Setting up a 401k is straightforward through your company's HR department, where you'll select your contribution percentage and investment options. For those without employer plans or who have maxed out their matching, IRAs offer excellent tax advantages. Opening an IRA requires only basic personal information and an initial deposit through any major bank or investment firm. When choosing between traditional and Roth options, consider your current tax bracket versus where you expect to be in retirement. Traditional IRAs offer tax deductions now, but tax your withdrawals later, while Roth IRAs provide tax-free withdrawals in retirement. Experts recommend that beginning investors start with low-cost index funds, or ETFs, within these accounts. These investments provide instant diversification across hundreds of companies and have historically delivered returns of 8 to 10% annually over the long term. These three steps, starting with any amount, automating your contributions, and choosing the right account type, create a powerful system that works silently in the background of your life. The beauty of this approach is that once set up, your wealth-building machine requires almost no maintenance while potentially generating hundreds of thousands of dollars over time. The impact of small changes. Now that your wealth-building machine is humming along, let's look at what's actually happening with your money when you start small. What if I told you that the difference between having $100,000 or $150,000 in retirement could be as simple as ordering one less takeout meal each month? Those small adjustments create ripple effects that grow exponentially over decades. Let's break down what happens when you invest just $100 every month. I know what you're thinking. Is $100 really enough to make a difference? Absolutely. When you invest $100 monthly at a 7% annual return, after the first year, you'll have contributed $1,200 and earned about $46 in returns. Not exactly life-changing yet, right? By year 5, you'll have put in $6,000 total, but your account will have grown to around $6,800. The growth is starting, but still feels modest. This is where many people give up, thinking their small contributions aren't making enough difference. But look what happens when we continue. By year 10, your $12,000 in contributions has grown to about $17,000. The snowball is getting bigger. By year 15, your $18,000 investment has become nearly $35,000. Now, we're talking. The real magic starts happening in the latter half of your journey. After 20 years, your $24,000 in total contributions will have grown to approximately $52,000. And if you stick with it for the full 30 years, your $36,000 in total contributions transforms into over $100,000. That's nearly triple what you put in. Now here's where it gets really interesting. What if you could find just $25 more each month to add to your investment? That's basically skipping one takeout lunch or making coffee at home a few times a week. Seem doable? Adding that extra $25 monthly for a total of $125 means you'd contribute $45,000 over 30 years instead of $36,000. But your final amount wouldn't just be proportionally higher, it would be significantly more. Instead of $100,000, you'd end up with about $130,000. That additional $9,000 in contributions, $25 times 12 months times 30 years, generated an extra $30,000 in your retirement fund. This is why small changes truly matter. Every additional dollar you invest works harder for you over time because of compound interest. The earlier you add that dollar, the more growth cycles it experiences. Let's look at another small change that creates massive results, improving your return rate. If you could increase your average return from 7% to 8%, which might simply mean choosing a different index fund or adjusting your investment allocation, your $100 monthly investment would grow to approximately $150,000 instead of $100,000 after 30 years. That's a $50,000 difference from just a 1% improvement in your return rate. What about improving your returns by 2%? At a 9% return, your same $100 monthly investment would grow to over $200,000 after 30 years. That's double the amount you'd have at 7%, without contributing a single extra dollar of your own money. These numbers aren't theoretical. They're mathematical realities that have worked for millions of everyday people. You don't need to be a financial expert or have a high-paying job to benefit from them. Anyone can access index funds that have historically delivered these kinds of returns over long periods. The beauty of starting with whatever amount you can afford is that you can always increase it later as your income grows. Maybe you start with $100 monthly in your 20s, increase to $200 in your 30s, and $500 in your 40s. Each increase dramatically amplifies your final results. What matters most is that you start now with whatever you can, even if it's just $50 or $25 a month. The math doesn't care about the amount, it only cares about time. And time is the ingredient you can never get back. The time versus money trade-off. Time is the ingredient you can never get back. And here's the harsh reality most people discover too late. Waiting until you have more money to invest actually costs you far more in the long run. Would you believe that someone investing just $200 monthly at age 25 could end up with more wealth than someone investing $800 monthly starting at age 45? This counterintuitive truth reveals the fundamental trade-off at the heart of wealth building. So many of us tell ourselves, I'll start investing when I get that raise, or I'll get serious about retirement once my kids are in school. But this thinking fundamentally misunderstands how compound interest actually creates wealth. Think about it this way. There's an inverse relationship between time and money when it comes to building wealth. The more time you have, the less money you need to contribute to reach the same financial goal. The less time you have, the more money you'll need to pour in to make up for those lost years of growth. Let's put some numbers to this. If you start investing at age 25 and contribute $200 monthly until retirement at 65, you'll put in about $96,000 of your own money over those 40 years. But if you wait until age 45 to start, you'd need to invest around $800 monthly for 20 years, contributing $192,000 total, to reach roughly the same end result. That's double the personal contribution for the same outcome, simply because you waited. What's happening here? It's not magic, it's mathematics. When you start earlier, a much greater percentage of your final nest egg comes from compound growth, rather than from your direct contributions. The person who starts at 25 might see 80 to 90% of their final wealth coming from growth, while the person starting at 45 might only see 40 to 50% coming from growth. The concept I want you to understand is what financial advisors call buying time. Every year you start earlier is like purchasing an incredibly valuable financial asset that will pay dividends for decades. Each year of delay is like throwing away that asset forever. You can never get it back. This principle applies to everyone, regardless of age. If you're 22, starting now with just $25 a month is mathematically superior to waiting until you're 30 and investing $100 monthly. If you're 40, starting today with $300 monthly will likely outperform waiting until 45 and investing $500 monthly. And here's where psychological barriers often trip us up. We become fixated on the amount we can afford to invest, focusing entirely on the dollars while overlooking the far more powerful variable, time. We tell ourselves stories about needing to clear debt first, or waiting to learn more about investing, or holding off until we feel more financially stable. What makes this particularly dangerous is that unlike many financial mistakes, this one happens silently through inaction. There's no bill that arrives showing you what that delay cost. There's no statement that lands in your mailbox quantifying the growth you missed. The cost of waiting is invisible until decades later, when it's far too late to correct. Even if you're in your 40s or 50s, this principle still matters tremendously. Starting today, even with a modest amount, puts time back on your side compared to waiting another year or 5. The psychological relief of beginning the journey often leads to increased contributions later, compounding the benefit. Many people attempt to catch up by making larger contributions later in life, but the math simply works against this approach. The compounding effect makes early dollars dramatically more valuable than later dollars, regardless of how many more of those later dollars you contribute. The key insight is to recognize that time, not the amount of your contribution, is the primary driver of wealth through compound interest. A modest monthly investment started today will likely outperform a much larger investment started years from now. The retirement fear solution. While time may be the primary driver of wealth, understanding this concept is what separates those who fear retirement from those who embrace it with confidence. Have you ever wondered why two people with identical incomes can have completely different outlooks about their financial futures? The answer isn't in their bank accounts. It's in their grasp of how money actually grows. A significant factor that separates those who feel confident about retirement from those who don't is their understanding of compound interest. Many individuals lack knowledge about how compound interest works, which leads to anxiety about their financial futures. It's not that one group earns more. It's that they understand more about how their money can work for them. Let me share something interesting. Research indicates that individuals who actively educate themselves about financial principles, including compound interest, are more likely to feel confident about their retirement plans. This knowledge empowers them to make informed decisions and take proactive steps in their financial journeys. They don't just know the terms, they truly grasp the concepts and can apply them. Take Maya, for example. She was a school teacher earning a modest salary who started learning about compound interest in her early 30s. Rather than feeling overwhelmed by retirement planning, she became fascinated by the growth potential of her investments. By understanding the 843 rule, she recognized that the seemingly slow growth in the first several years was completely normal. This knowledge gave her the patience to stay invested during market downturns, knowing that the explosive growth phase would eventually come. The psychological aspect of retirement planning reveals that fear often stems from a lack of understanding. Those who grasp the concept of compound interest and its implications for long-term savings tend to experience less anxiety about retirement. When you can visualize how your money grows over time, retirement planning becomes less about fear and more about strategy. A survey found that individuals with higher financial literacy, particularly regarding compound interest, report feeling significantly more prepared for retirement. This correlation suggests that improving financial education could alleviate retirement fears for many. It's like having a map for a journey. Knowing where you're going makes the trip less stressful. Consider the contrast between two neighbors with similar incomes. James panics about retirement and constantly worries about saving enough, frequently checking his accounts and making emotional investment decisions. Meanwhile, Lisa understands compound interest deeply and approaches retirement planning with calm confidence. She knows that time is working in her favor and makes consistent, rational decisions based on long-term growth principles rather than short-term market fluctuations. Experts emphasize that understanding the time value of money and the exponential growth potential of investments through compound interest is crucial for building retirement confidence. This understanding allows individuals to set realistic goals and timelines for their financial futures. They can see the full picture of their retirement journey, not just the current balance of their accounts. People who understand compound interest approach financial decisions completely differently. Instead of seeing retirement as a massive mountain of money they'll never save, they recognize it as a mathematical certainty if they follow simple principles consistently. They don't need to save enormous amounts. They just need to start early, remain consistent, and let time do the heavy lifting. What separates the retirement confident from the retirement fearful isn't wealth or income. It's knowledge and perspective. The 843 rule serves as a roadmap for individuals to understand how their investments can grow over time. This framework helps demystify the process and encourages consistent investing, which is key to overcoming retirement anxiety. The good news: this confidence is available to anyone willing to learn. You don't need a finance degree or a six-figure income to join the confident minority. You just need to understand a few key principles and apply them consistently over time. The transformation from fear to confidence doesn't happen overnight, but neither does retirement planning. As we wrap up today, let's reflect on what the statistics actually tell us about compound interest. It's sobering that only 39% of Americans truly understand how compound interest works. This knowledge gap explains why so many fail to take full advantage of this powerful wealth-building tool. The wisdom from Warren Buffett rings especially true. The stock market is designed to transfer money from the active to the patient. This perfectly captures what we've explored together. The magic of compound interest doesn't happen overnight. It requires maintaining that long-term perspective. The choice is simple but profound. Will you join the patient investors who understand compounding and earn its rewards? Or will you remain among those who don't grasp its power and ultimately pay the price? Remember, you don't need a huge amount to start. What you really need is time, the essential ingredient that makes compound